Okay, we're back at it again. It is your host, Tony, the head financial analyst at FinancialJuice, and of course, running this preview with you for the Bank of Canada from MACROACE. So, over the waters, let's go through what it is, how it affects the markets, what is the sentiment surrounding the Bank of Canada at the moment, what they did in the past, and what to expect from the markets. So, how does it affect the markets? Whenever the rates are raised, that boosts the value of the currency. And of course, the reason why the value of currency goes up is because international investors, traders, and businesses will tend to favor a rate that gives you a high amount of return rather than one compared to another one that is smaller. Okay, so stock market, when you do have a rate hiking cycle that's going on and the central bank is focused on cooling the economy rather than letting it heat up, then if you do get whenever they raise interest rates to cool the economy, stock markets usually take a hit. Valuations start to go down or go down even further in the anticipation that businesses, of course, businesses won't be able to borrow as much money to spend on the goods and services that they need to then provide the goods or services to consumers, and that's the main reason why stocks usually go down. For the bond market, again, similar to the same as the US, if you do see if the rate is raised higher than expected, then yields on those bonds start to go higher, and then the bond prices go lower. Again, in the expectation and anticipation that the central bank will continue raising rates or raise rates by a bigger amount. Now, where is the economy at the moment? So, what is the central bank? What is the Bank of Canada looking at the moment to make their decision? So, of course, first of all, CPI is the headline read that everyone looks at for any nation. So CPI was at 3.4% compared to 4.4%. CPI trim, or the core CPI for Canada, was at 3.8% compared to 4.2%. GDP quarter-on-quarter annualized rate at 3.1% compared to Q4 0%. Employment change, which we had last week, was at 60K compared to minus 17.3K. Average hourly earnings ticked down as well to 3.9% compared to 5.1%. Unemployment rates ticked up to 5.4 compared to 5.2. Retail sales was about 1.1% compared to minus 1.4%. PPI year on year also ticked further down to minus 6.3% compared to minus 3.5%. Raw material price index, or the RMPI index month on month, ticked down to minus 4.9% compared to the prior of 2.9%. And then the IV PMI data was at 50.2 compared to 53.5. So usually with the PMI data, a figure above 50 denotes that there is an expansion phase, and a figure below 50 shows there is contraction. And particularly when you get to 47.1 is what economists refer to as when that sector is within a recessionary area and it's not doing well. Then with the previous Bank of Canada rate decisions, of course, there was the surprise 25 base point hike to 4.75% that was taken. Of course, markets were expecting at that time, markets were expecting no change for the rate to remain unchanged at 4.5%. So from the statement, what they said, so they removed April language about how the bank is prepared to raise rates further if needed. They continue to expect CPI inflation to ease to around 3% in the summer, but they dropped the reference that inflation gradually falling to the 2% target by the end of 2024. Underlying inflation remains stubbornly high globally, and major central banks are signaling that rates might have to rise further to restore price stability. The meeting minutes then later on in June. What we had was ahead of the June 7th decision. Governing Council debated whether to keep rates on hold and signal a hike and signal that a hike was likely in July. Data available since April decision tipped the balance of risks to the inflation outlook to the upside. and the Bank of Canada survey Q2 on June 30th. So from that survey, it said that CPI is expected to remain high due to government spending and strong demand. Fewer firms and consumers expect a recession. Expectation for 5-year head inflation have edged down to 2.89% from 2.92%. For the 1-year head inflation, expectation fell to 5.09% from 6.03% in Q1. 2-year head inflation expectation dropped 3.93% from 4.27%. So just going over what we've seen so far, there isn't really a lot that comes out from the Bank of Canada members themselves. But it's important to note the language shift and change from the Bank of Canada. So as we were looking here before, where they removed the April language about how the bank is prepared to raise rates further if needed, now they're taking, although they did a hike, it's more of it can be seen as it could be viewed as a dovish hike in the fact that they're not saying they're prepared to raise rates further, but they understand that other central banks are raising rates if underlying inflation remains stubbornly high, and that the rates might have to rise further to restore price stability. So not saying that they're ready to that they're definitely ready to pull the trigger. It's more so that they're, to take that in, the easiest way to understand it, again, they're being more data dependent. What's going on in the economy and whether or not underlying inflation, basically, as I said, data dependent, whether or not underlying inflation is coming down fast enough for them to say, okay, job done. So now, moving on from the consumer sentiment, so Bank of Canada views, again, very limited between the time from the last rate decision and up until now. So June 8th, you had Bank of Canada's Deputy Governor Beardry said that the bank still expects headline inflation to be near 3% in the summer, but that is largely due to lower energy prices and base year effects. Then the sentiment and views, again, was quite important to understand what are the big boys in Canada, the big banks in Canada, thinking about the central bank. So post-jobs data, a rate hike was seen by all Canada's big 6 banks on strong jobs data. So one of those, of course, being CIBC, that joins their peers in seeing the Bank of Canada raising rates. So what they said is that the data is probably just strong enough to see policymakers pull the trigger on another 25 basis point hike, rather than wait until September, as they had previously forecasted for what they would expect the Bank of Canada to do. So again, as said, the jobs data came in at 60k. It was higher than what the forecast was. There was about a 40k deviation, I believe. Let me just double check that if I am correct in saying that. Of 39.9k. Yeah, 40k deviation from the employment data, which was higher than the deviation, or slightly higher than the deviation that we were looking at or looking for the Canadian data. But that was then overshadowed by the US release. So you didn't really get that much of a reaction from the Canadian dollar itself. Right, but from here again, as the big banks are doing too, they're also being reliant on what the data provides. So as you have other central banks in the world, so the ECB being reliant on data on CPI to see where it is for them to then make the decision and then to pull the trigger or not. Carry on then. So Saxo Bank, what they said today, they said that with markets divided on the odds of a hike, even if the Bank of Canada delivers a hike, there is likely little hawkishness potential in guidance. So more or less a dovish hike. So again, taking the hike because they feel it's needed, but not because that they feel that they can. But there is also the thought that if they do overdo it, then it might damage the Canadian economy further. So the kind of comments you might be looking for from the Bank of Canada. Again, if they do decide to hike as expected, that they would cite inflation as being one of the factors that they're still looking out for, and that the jobs market would, as you'd seen from CIBC and the other big banks in Canada, that it would have tipped them into the direction and thinking that they need to continue raising rates. So that spillover effect from more jobs being added to the economy and the potential for more people to then spend in the economy doesn't get out of hand. The other point to make clear then is that if you do have the central bank that decides that they're going to pause rates instead, then which would go against expectation, then they could cite that maybe they've done enough with the rates, and that the jobs market is strong or the labor market is strong in Canada to be able to deal with where the rates are at the moment, and that there isn't any further need, or removing the language completely about rate hikes altogether, and just saying that they're going to more or less stand pat where they are, and then see the effects of where their rate hiking path has got them. So I said, earlier on, if you've seen my previous video with the with the US CPI data that we just had, then don't forget to share the video, like the video, subscribe to the channel, get the word out there about it, and let people know about MACROACE. So if we carry on then, so if we look at the previous market reaction that we had seen from the Bank of Canada, this is a nice clean reaction from the Canadian dollar because it was higher than expected. Okay, there wasn't any because of the surprise. It made the direction. It gave a clear direction as to where the Canadian dollar had gone. The only thing to be aware of though is that, of course, with the slightly dovish comments from the Bank of Canada, that would have been one thing that did hamper how far the Canadian dollar has strengthened. But nonetheless, we do have the market reaction. So I'll just show you this here of what we had previously seen from the Bank of Canada, and why whenever there is a surprise, you get a bigger market reaction if there is something that's if the rate comes in as unexpected at a certain level, whether that be above or below the forecast. So this is about 10 seconds before the last release we'd seen back on June 7th. Okay, so you can see there that there was a 25 basis point hike that was taken, okay, to forcible 75%, surprise. And you'd seen that the Canadian dollar had strengthened quite a bit, to the point where on GP CAD you had seen about 80.5 pips towards the downside on GP CAD. And I think that's the strongest market reaction that we've seen from GP CAD since December the 7th of last year, of 2022. So again, when there is a surprise with the figure itself, then there tends to be a stronger move that occurs from what we've seen. But back then, one thing to note, that there wasn't a surprise in the rate itself. It was the hawkish comments that led to the Canadian dollar strengthening by a lot. So what does that mean? What I'm trying to say is not just the rate itself. The rate itself is not just important, is not the only thing that's important. It's also the statement that comes with the rate decision itself too. Because you could get a surprise rate decision, but then the statement could be so let's say you could get a hawkish, you could get a interest rate hike, but then the statement could be very dovish, and that could hamper how much that currency strengthens, depending on what's been said. So that's one thing to be aware of too. So we have two things to be aware of: the rate itself, and then the rate statement. What do they say that we need to be aware of? Do they say that inflation? Do they deliver a 25 basis point hike, but they then say that inflation is cooling down? Inflation continues to cool down, and the jobs market can continue to handle the rates that they've set for the country. Do they cite maybe that there might be some external shocks that is affecting Canada? Again, dovish comments paired with a surprise rate hike could give you the opposite effect sometimes, where maybe you don't see any strengthening at all. You might see some weakening, but again, we'll sieve through the comments when they come through on our side. So if we kind of skip forward and kind of see what happened. Okay. Yeah. So this was, again, you can see there was about 18.5 pip move on GBP CAD. So that's been the biggest mover, more or less, in the currency pair. If we're in the currency pairs, if we're comparing it to other currencies. But the other contender is also the Japanese yen. So let me bring up the deviations for you here. Let's kind of get out of this. So let me go over it again whilst I bring this up. So when the reaction, when there is a obvious surprise, the markets have a clear direction to go in. For economic releases, for monetary policy decisions, it's a bit trickier. So here we go. So let's see what was said. So again, if you joined me last time, you will know that the deviations shows you how the markets react, or how strong is the market reaction to an economic release or releases. And here we can see that the last rate decision that we'd seen, 7th of June, again, as I said, there was a surprise 75 basis point hike. And then the currency pair that had the biggest reaction was GBP CAD. So this figure here represents the initial move on the 1 minute candle going to the wick of the candle, okay? And then the figure in brackets, if it doesn't have another word like up or down, it usually means it's going in the same direction. And after this is 10 minutes after trading from the initial market reaction. So it's about 59 pips down. So basically there was a little bit of a pullback from the market, from the initial market reaction. Okay, so also here, so as if you'd seen the sentiment from last time, if you had subscribed to the email, so there was, of course, the surprise rate hike of 25 basis point hikes, 25 basis point hike that was taken. Language was removed of reducing, language was removed referencing inflation gradually falling to 2% target by the end of 2024. Also cited Q1 GDP and consumption growth being stronger than expected. So again, all these economic releases, sometimes people might not realize that, they kind of need to put the picture together, because that's what the central bank does. They put the picture together and say, right, that's what we're going to do. We're going to raise rates or pause or cut rates instead. Okay, so so we've got about 9 minutes left. So this here, so what I'm actually going to do, what I can do now, I've just did a little test, is for those who have subscribed to the mailing list, you'll be able to get access to the deviations sheet. Okay, and that's for all the economic releases. You'll be able to see that. I think my worry was that would it be anonymous, or would people be able to see everyone else's email? But I've seen that that's not the case. That's all good. So that's something that I'll be able to share with you guys, but only if you're a subscriber to the MACROACE mailing list. So in the mailing list, what I do is I provide not only the deviations for the economic releases or the deviation sheet, but you also get, have the opportunity, or actually you also get the expectations for what to expect in the week ahead for Europe, Asia, and the US session, i.e., type of news or releases that are expected. It's not big, it's quite short. It isn't filled with graphs or charts because I go through that information here with you guys in more detail. And it's better to have a short rundown and then an explainer video here because you might take notes from it, but it's sort of better done in person like this, I think. Okay, so that's deviations. So again, let's go over what you could expect. So if you do get a rate hike, then usually when the rate comes in as expected, you don't get that much of a market reaction unless the statement itself is either very hawkish, i.e., there's a repeat of the rhetoric that inflation is if inflation continues to be too high, and that even more work needs to be taken to bring it down or to cool the economy. Then you might see a stronger reaction from the Canadian dollar. However, saying that, if there is a repeat of the language that we've seen from the last statement, then again, the reaction might not be that strong because it's a repeat. It's nothing fresh or new to kind of shock or surprise the markets. So if they do talk about the jobs data being stronger than expected, that could, again, there is a potential for the Canadian dollar to strengthen, but in the past when things have been repeated, it might not. There is a potential it might not because it's not new news that or new compared to the previous statement. The other thing is that if they do decide to hold rates, okay, rather than hiking the interest rate, then you could see some strong downside movement for the Canadian dollar. But if it's a hold, but that they're still open to raising rates in the future, there might not be a downside movement, or what could happen is there would be a downside movement, but it's hampered or kind of moderated by the dovish, by hawkish comments, within the statement. So dovish comments, again, as said, if they feel that inflation will be lower by the year end than what they had previously seen, or if they expect GDP to fall off or get worse, or the job or the labor market to weaken or be hampered, or consumer spending to fall off, which will be a complete U-turn from what they said last time round. That would be a surprise, and that could lead to the Canadian dollar actually weakening instead. If they provide a bleaker outlook for the economy than they had done in the past. But you need a lot of bleakness for that to occur. But yes, okay, so about 5 minutes left to go. So FinancialJuice, as well, we'll be seeing the data appear. Now, FinancialJuice, if you haven't heard of it before, then it is a live voice and text service that allows you to understand what's going on in the markets and why. And what do I mean by that? What I don't mean is that it's going to tell you which way to trade. It provides information as to what news could be or is affecting the markets. Okay, so let me explain that again. The big boys and traders, the big traders, they use a live voice and text service to manage their risk. If there is a headline that comes out that they feel is going to move the markets, or they could capitalize on that potential news and trade the markets instead. Okay, so for day traders, right? Particularly in particular, this is made for day traders, right? You're looking at the charts throughout the day, and there may be a big old wick, a big old candle that's just popped up, that's just appeared on, let's say, the S&P or CAD-JPY, okay, whatever it may be. You might not know what's caused that move, okay, but if you have a live voice and text service, then you will know what's caused the moves, what's caused the move, more than likely, okay? Because that's our job, to provide you real-time live voice and text service for you, so then you can manage your risk and capitalize on potential trades. If you've never come across a live voice and text service, so what you can do is you can sign up to the FinancialJuice newsfeed here on the link here. And if you have had, let's say, if you've never come if you've never come across a live voice and text service, it's your first time, you can stay on the free version. There is a delay. There are adverts that play, but it's still useful to kind of get used to and understand what the difference. To understand how a live voice and text service works, and then how you might be able to apply that to your own trading as well throughout the day. But if you want to sign up for the pro version of FinancialJuice, then what you can do is, well, first of all, make sure you have an account and that you've verified it in an email that's sent to you. Okay, and then you go back to the website, and then here there's a link or a button that says Go Pro. Click that. Select your subscription, whatever you want it to be, whatever you want to choose. Go back to the website, log out, and then log back in, and that'll act as a verification, and then you'll get this beautiful site here. Okay, 1 minute to go to the right decision. Let's get on with it. All right, 1 minute to go. I've got my TICKSTRIKE up and ready. Okay, 10 seconds. Okay, 25 base. That's 25 base point hike. 25 base point hike as expected to 5%. Okay, let's see what the statement says itself. Let's see if they've got anything interesting. So recent cooling of CPI fueled by lower prices. Projects. Let's see what else they see. They project hitting 2% CPI target in mid-2025. Early call was for the end of 2024. Bank of Canada anticipates less near-term downward momentum in CPI. So again, talking about CPI noting the recent cooling in CPI fueled by lower energy prices. They're concerned by progress towards the 2% CPI target that could stall. They expect output gap to close 9 months later in early 2024. What else we got here? CPI to hover around 3% for the next 12 months. Okay, what else we got? Canada GDP now seen at 1.8% compared to 1.2%. 2024 this year, and 1.8% this year, 1.2% 2024, and 2.4% in 2025. Okay, so you did see the Canadian dollar asset strengthen again. I think one of the things is that okay, is they're concerned about the progress towards their 2% inflation target that could stall. So there might be a need to continue hiking instead. But they don't give, but the Bank of Canada says they're going to assess data, and they don't give any guidance on future path of rates. CPI returning to target 6 months later in mid-2025. Stubbornness of core inflation in Canada suggests that inflation may be more persistent than originally thought. So again, more work to do. Canada's economy has been stronger than expected with more momentum in demand. I think that's basically it. Yeah, so going back to the GDP forecast, they upgraded their forecast basically for this year from 1.4% to 1.8%. Downgraded it for 2024 slightly to 1.2 from 1.3, and 2025 2.4 from 2.4 from 2.5 for 2025. Let's see what else they have. Okay. All right, so that's basically that there. I'm also looking at unusual activity here too. So the difference. So first of all, we've got TICKSTRIKE. TICKSTRIKE allows you to look at the order flow within stocks, forex, currencies, crypto, ETFs and ETNs, and also your internals. Okay. So that shows you how strong the buying or selling momentum is. Unusual activity shows you when the movement of a certain asset is above its average in the 99th percentile. Okay, so we can see here dollar Swiss franc is seeing bigger movements, big amount of volatility than it usually does. Compared to what it usually does. Let's see. What else we got? Of course, CAD Swiss franc. Okay. So again, this is more to do. So it's trading high probability stocks, futures, forex, and crypto breakouts in real time, compared to again, think of it like a moving car. If you're going at 50 kilometers an hour is your average speed, but then one day you suddenly go 90 kilometers an hour, then again that's that's unexpected. Well, there's again, it's unusual activity, so it would pop up as it does here on unusual activity to give you a notification here. All right, so EuroCAD went down. Let's see how big the reaction was. So I know, as we said last time, that GP-CAD had the biggest reaction. Let's see. So here, so 44.1 pips towards the downside. GP-CAD, see what you had. Okay, 49.3. Not much of a difference. CAD JPY. 37.5. Okay, so GP-CAD still has the biggest move so far. CAD Swiss franc, 18 or 19 pips, let's say, towards the upside. Let's bring in CAD. about 30, say 31. Yeah, okay, 31 pips down. Okay. So, yeah, so unusual activity. Let me share the link for you on the chat as well. So here we go. There we are. That is a link to unusual activity there. Also, if we've talked about also TICKSTRIKE as well. I've talked about it before, but again, it represents how strong the buying or selling momentum is within different assets. As you can see here, so this little box is called the ticker box, and a plus symbol shows the buying momentum and vice versa. Then the number here shows you the sensitivity. So 1 is the most sensitive to market reactions, i.e. when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE pops off. But if you want to increase that, decrease the level of sensitivity, just move the slider up to 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that's going on will TICKSTRIKE pop off. And of course, if you're day trading, you're scalping the markets, again, it's another tool to add to your arsenal there. All right, so let's... that is basically it for... also, yes, MACROACE, which we've got that there. That's basically it for the stream. So enjoy your weekend. Don't forget to like the video, subscribe to the channel, get the word out there, and I will see you guys next time.